Welcome to your commercial-free, uninterrupted investment show, sponsored by the SEC-registered investment firm, Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who has been putting clients' investment needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello and welcome to the Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management. We got a lot to talk about today. We'll take your calls later on about what you want to talk about. We were going to talk about the jobs report. Got to talk about that. It comes out once a month on Friday, so we'd like to talk about that when it comes out. Personal Consumption Expenditures. Also going to talk about the National Retail Federation, about the retail sales for Christmas. And I do want to discuss what the SEC does with all their fines. Chase?
Do we know what they do with it?
Well, what they're supposed to do with it, I guess we'll put it that way.
Well, but as you said, we're always here to take your calls, answer any questions you may have. You want to call in about a particular company. We'll go through those valuation ratios, take a close look at the balance sheet, those fundamentals that we like to break down here at Wilsey Asset Management. You want to join the show, phone number 833-288-0973. Again, 833-288-0973.
And I'm impressed. I think you read that number upside down, didn't you?
Yeah, I get lots of practice. It's funny, we had a client come into the office I think it was this past week, and he was trying to read something upside down, and we were kind of looking at the same document at the same time. And I'm like, I'll just flip it for you, because I can read pretty well upside down now, because when people come in and we do our presentation, it's all upside down, so I become pretty proficient.
Yeah, and it is a practice thing you kind of do, so you can do it. But I just looked over and glanced at you like, oh, the numbers are here, but you're reading upside down. So anyways, let's talk about that jobs report because, again, this is the last one that we'll see for 2022. And we saw some job gains, a nice increase, about 263,000 November, which easily topped the estimate of 200,000. Now, leisure and hospitality remain a major leader with job gains totaling 88,000 in the month as the sector continues to battle back from COVID. The sector still remains 5.8% or 980,000 jobs below February 2020. Now, I was shocked that number because you hear about how much money we've gained back on the retail and the hospitality side. Wow, still down 980,000 jobs since February 2020. And then retail, trade, and transportation and warehousing were the standout losers in the report, as both sectors saw a decline in payrolls. Retail trade fell by about 30,000 jobs, as general merchandise stores saw employment decline by 32,000 jobs, and electronics and appliance stores, saw employment decline by 4,000 jobs in the month.
And then transportation and warehousing, as I said, also had a decline. That was 15,000 jobs in the month. I was somewhat surprised to see these two sectors decline considering it's the holiday season. But then I kind of took a closer look and I was thinking about it. And I was wondering if the excess inventory levels could be weighing on employment levels, as retailers could really be trying to focus on expenses. If you have all that inventory, that hurts your margins. They could be saying, we got to focus on our labor costs. And also, too, if you have all that excess inventory, you're trying to build down or reduce that inventory in warehousing, so you might be needing less space in those warehouses. If you already have all the inventory, you don't need to transport as much inventory. So that could be weighing on the sector as well, is kind of how I thought through those two different items. The item that I believe weighed most on the markets was the increase of 5.1% in average hourly earnings. It surpassed the estimate of 4.6%, and it could give the Fed more ammo to continue on its rate hiking path as it tries to bring down inflation. I do believe, however, that this should not be a major concern for the Fed because, like inflation overall, I think wage gains will begin to slow to a more normalized level next year as the job market decelerates.
And this report, because I believe it was like Tuesday or Wednesday, we had an inflation report came out, and I think that day the Dow's up 700 points, and I knew, the Fed's not going to increase more than expected and so forth. And that's what it is. It's not that they're not going to increase, that they're not going to increase more than expected. That is what concerns the market. So when we saw this here, then all of a sudden people started thinking, or traders, and this is what moves the market, the traders, not the investors, like, wait, this could change again now. Now because of the wages being up 5.1%. Oh, now they could go above 0.75 and do 1%. So this is what drives the variations or the volatility in the market, which is why you have to be an investor and not worry so much about these things. Because, and this is why we do the newsletter, so you can stay on track with investing and not be whipsawed every single day by the different craziness comes out from the market.
Yeah, and I think the thing I want to look at is I'm hoping the Fed is somewhat interpreting the data somewhat the same way we are, where you're going to see some of this inflation slow. And I'm hoping that they won't go crazy and still hike, at 0.75%. I don't think that's going to be the case, but you never know. But the thing that I'm looking at here is we've kind of talked about how you see all the headlines and, tech is having layoffs and so forth. But we just talked about the service sector. Well, there still are tons of open jobs that we talked about last week on the show that need to be filled as well. So I don't think you're going to see, I think last year the average job gain was like 500,000 a month or something. It was something crazy. Yeah. We're not going to see that, especially in 2023. I think you could perhaps even see sub 200,000 a month. Right. Doesn't mean that it's a bad job market. It's just not as good as it was. It's, again, decelerating, not declining. Very important to look at those two distinctions. However, I think if you see that slowdown in job gains, it's not going to be as competitive. So that's where I think that average hourly earnings could come down, especially if you look at the service sector versus tech. Tech generally, you look at Facebook and Google, a lot of times I feel like they kind of overpaid people several years ago, and now that's kind of why they're starting to pull back. It's like, here's $200,000. Here's $100,000. And now they're kind of looking at that like, ooh, that was kind of maybe too much. That perhaps could be why they're having a layoff. So you could have people that were going from a job making $200,000 to, let's say, $150,000 in the service sector.
Right.
So that could slow the wage gains next year, which I think, again, could be very beneficial to the overall inflation picture.
Yeah, and these are things you have to kind of look at and take the data, analyze it, and say what's really going to happen. And again, you're going to have on the days where, now the Fed's going to raise rates more than expected, market will go down. But you got to look at what's going to happen 2, 3, 4, 6 months, 12 months down the road. So that's why we do this. And that kind of brings me to the next one, which is the Personal Consumption Expenditures. The PCE, as it's known, which is known as the Personal Consumption Expenditures, came out at 6% for October over the last 12 months. As we had predicted months ago, these inflation indexes will show signs of easing. This is why there has been some recovery in equities.
And the PCE is what the Federal Reserve looks at in regard to interest rates, so there probably will not be any surprises going forward. We continue to believe that inflation will slow down, and if you've been out of the market, in particular the right equities since summer, you've missed out. There are still opportunities to get back in for quality long-term investors, but sitting on the sidelines for the next 6 to 12 months, based on the current data, we believe will be a mistake. And again, I don't think you're going to see the market go up 40% or anything, but you sitting in cash, you could be missing out on a good quality equity that could produce a nice 8-10% return here over the next 6-12 months.
And we like the volatility. I mean, yesterday we had a company that we watched them very closely that has not been a buy in, I'm going to say weeks maybe. I'm not sure when the last time we bought it.
It's going to be a month or so.
Maybe a month or so. And yesterday it came down. Like, we like this volatility because we were able to, new money coming in. Okay, now we can buy XYZ company. And by the way, that's not a true symbol, so don't go out and buy XYZ company. So we stepped in. We bought, I don't know, I think we hit, 30 different accounts or something? It was more than
like 30
expensive.
different accounts.
Yeah, 30 different accounts. So I don't know, $1 million or whatever it was that we spent for people. Because, again, we're being patient. We like the volatility because we're looking longer term on what is going on with the businesses. And we love this short-term volatility because we can step back in and buy more when the time is right.
Yeah, no, absolutely. I mean, I think what's going to happen here, too, is generally we have that Santa Claus rally. Are we going to get one? I'm still not sure. I mean, we've kind of had a nice recovery here over the last few weeks. Is that going to continue? That's for the traders to decide, I guess. It's not really going to impact our investing decisions at the end of the day.
Right.
But, it's something that you can't ever try and time and play that game. It's, what's going to happen over the next 3 weeks? I don't know. Right. You can try and guess, try and plan. You can look at history, but sometimes, let's say 70% of the time there's Santa Claus rally. Well, that still means there's 30% of the time that there's not. You got to be okay with that. You can't try and play these games and play these rules of thumb because that's how you get burned. Because all of a sudden it's like, well, now it didn't happen this time.
Well, I think we could have it for one thing I was concerned about was the rail strike. It looks like that's been averted, so we're okay with that. We talked about this PCE. What's coming up next, I think it comes out this coming week, is the CPI.
Mm-hmm.
And even though the Fed looks at the PCE, I think a lot of people look at the CPI. So that comes out this week. And if that's like the PCE, I think we'll be okay, and I think we'll have more of a rally. And
just real quick, because
Sure.
I believe the Fed meets, it's either the 12th or the 14th or in that window somewhere. So that...
And they meet after the CPI comes out.
They meet after the CPI. So that's really, I think, what's going to potentially change and dictate that Santa Claus rally is that meeting.
Right. And that's true, because last time when the CPI came out, I think, and then the Fed met, I think there was a big rally at that point in time, and that could be the Christmas rally if we get a decent CPI report. And based on the PCE, I think we could get a decent CPI.
Yeah. And I mean, the thing to look at, too, is the PCE is still at 6%. It's still 3 times what the Fed wants at 2%. But again, it should start to decelerate naturally, not because we need to hike rates another 4%, let's say, or anything crazy.
And the thing is, we're well above what the inflation is supposed to be. But far better, because if you remember a few months ago, people said, oh, you don't get it. Inflation's like the 70s is going to 12, 14%. We said, no, just don't see that because of the commodities and so forth. And so that's what we're seeing now, things from 6 months ago, and still not seeing any reason for inflation to be at 10, 12%. But we do have more to go to get back to that too. But I as we said before, we predict back in the summer, and we'll see if we're right. We said by December it'll be around 6 to 7%. We'll see what the CPI is.
Yeah, and I will say one thing that still concerns me is that's not talked about that much is the price of diesel. And we met with business owners here that have a seafood restaurant, and they're kind of joking and saying, like, when you're talking about inflation, I want to jump through the radio and grab you because they're getting crushed in their business with the cost of seafood. And I never thought about this, but it's not just seafood, obviously. There's lots of different industries that really hinge off the price of diesel. I mean, talk about transportation and in particular, the reason seafood is dependent on it is because all the fishermen that have to go off and use diesel in their boats.
Yeah.
That price of diesel is not talked about that much, but it is still extremely elevated. And again, if that can somehow get reduced by somehow, I think I have some ideas of how we could reduce that, regulations, that would be a huge benefit to the economy because that would really bring down inflation as transportation impacts so many parts of the economy.
Well, and here's one thing I think is going to happen. I'll give you the good and the bad, is that because we've seen now gas drop dramatically, you're a refiner. That's the problem is with diesel being refined. So it's like, okay, now wait a minute. Diesel's much higher. So let me kind of turn down the gas refinery and turn on the diesel refinery, which means more diesel, which means diesel will come down.
And gas will go up.
Gas will go back up again. And the problem is because like people like, and I'm sorry, I got to say this, our crazy governor, refiners want to refine this oil. And again, I'll say our crazy president who's getting oil from Venezuela. It's a heavy crude. Refiners love to do that because that's great for refining. But they're not sure if Governor Newsom will let the refiners in California refine the crude from Venezuela. And the answer to that is probably no, because he says you can't refine anything that's not produced here in California. So that could be a problem.
But I thought they didn't want to produce anything in California. So where are we going to get it?
Well, that's what I'm saying. And so our, we got this oil coming from Venezuela. It's a heavy crude. And they're saying that in California, well, you can't refine it here. So we're getting the crude, but you can't refine it. It's just the politics gets in the way. We need politicians that understand how the economy works. And yes, I know you want to be green, but you're not going to get green until we can get energy produced here. So we got way off track, but it's just so important on how the fundamentals work and why we still have energy in the portfolio.
And ultimately what it comes down to is that I think is going to be the driving factor of inflation next year. And again, I don't see diesel going from I think it's around $5 a gallon up to $10 a gallon. It's not going to double like it did before, but if that could come down, that would be a huge tailwind for overall inflation.
And I know we do have a shortage of refiners. That's the other thing, too. They won't let them build any more refiners, but I don't know the number of how many are in California versus the rest of the U.S., because the rest of the U.S. can refine the Venezuela oil, but it does not look like California will be able to. And I think we have a few here in California.
I think And this is just because the refiner we have in the portfolio, a majority of their refiners are in the Gulf Coast. I think that's where a lot of refiners are at, is the Gulf Coast.
So, yeah, little problems that we have there. Let's go back to the Christmas holiday here, and you probably heard that this is not going to be a good Christmas for retail. But as we say many times in our posts and other commentary, it's important to understand what is being said and how it is being said. The estimate by the National Retail Federation, NRF, for holiday sales expect to be between $942 billion to $960 billion, an increase of 6.8% over the $889 billion in 2021.
This was a 13.5% increase over 2020. And then if we look back to 2019, when the economy was, pretty strong, I would say. A lot of people, the economy's great in 2019. Well, back then, if we look at that, let's see here, comparing to the low, there we go. If the economy back in 2019, everyone felt good. The NRF said holiday sales were $716 billion. That's the number I was looking for. I got it lost on my notes here. Comparing the low end for 2022 of $942 billion, well, that's a 31.6% increase from 2019. It does appear holiday shopping has gotten off to a good start as well, considering the record of 196.7 million shoppers from Thanksgiving Day through Cyber Monday. This topped last year's level of 176 million shoppers and easily surpassed the NRF's estimate for 166.3 million shoppers. I don't know about you, but I think those are pretty good numbers, all things being equal.
Yeah, and that's why people are saying, it's not going to be a good holiday season. What are you looking at? And again, when you compare numbers to, again, 2019, they are, up 30%. That's huge. Yeah. And I was thinking as you were talking there, is it going to be next year when we reach $1 trillion sales? Ooh. And that's a big number. So we're on the right path there. And I even heard people are buying Pelotons.
Oh, wow. Well, and I will say, this obviously doesn't account for inflation. So that's going to be your negative news. Right. It doesn't account for... But the sales are still... Companies are still selling more. Mm-hmm. Even if it's not more volume, still overall the dollars are increasing, which if we had a terrible economy, that would not be the case. And I think that, we're still... I don't want to pretend and sugarcoat and say everything is great.
Right, it's not.
But things are okay. All this doom and gloom, I think, is just complete nonsense. I think, again, when people talk to us, we think we could have a recession next year in 2023. It's just not going to be that bad.
Right.
So be careful saying, don't be blind to say things are amazing. But I don't think it's going to be super negative.
Yeah, and the big thing, too, is that, and I've said this before, when you have a job, and I don't think anybody feels like they're going to lose their job. There might be some, maybe a tech company or something, but overall, most people are very comfortable with their job. And if they're not comfortable, they still know that, I see a lot of help wanted signs out there. We talked last week about the JOLTS report, 10.3 million jobs outstanding, 6 million people, unemployed. So you feel pretty comfortable that you have a job. So you don't like the inflation. It is a holiday season. You know what? So I'll put a little bit extra on the credit card. I'll make this a good Christmas. But you feel comfortable with your job, and that's the big difference about this recession that people are missing, is that people feel confident about their job and they're not pulling back on the spending. They don't like it. They don't like inflation, but they're not pulling back.
Yeah, and I had somebody comment on one of our posts about the savings rate. And the savings rate has fallen tremendously. Right. And it actually is based off the chart he showed, and I believe it's below historical standards. It's quite low. But the saving rate looks at your monthly spending to your monthly income. If you look at the chart of the savings rate, in 2020, it was like 30%.
Yeah.
You had all this buildup, and that's what we talk about with the M2 and the liquidity in the economy, is there's still so much there from all the savings that was created that now people are kind of spending through those savings. While, yes, it's going on a credit card, they still have the savings to pay off those credit cards. It's going to become a problem now, however, if the savings rate still remains historically low at the end of next year. That's when I start to get a little bit worried. But right now, there's just too much liquidity to get us through this problem.
Yeah, and the gentleman didn't understand the savings rate versus the M2. The savings rate can go down, but you can still have a lot of money in the savings account is what you have. It's not the savings are going down. The rate is going down. And M2 does include a lot of different money. It's not just in people, but also businesses, which is important as well, because if businesses start pulling back also. So that's what he got confused, saying the savings rate. He didn't understand what the M2 is.
Well, that's again what we talk about with people is you fixate on one data point that's so negative, but you have to look at the big picture. There's so many different data points that work together in the economy, and that's what you need to look at. You can't. There's always going to be one piece of news that is going to be extremely negative. I don't care how good the economy is. There's going to be one thing that's going to be bad.
Yeah, somebody's going to find something bad. So, phone number is 833-288-0973. We're going to take your calls just in a few minutes here. 833-288-0973. As promised, I saw this, and we just have to talk about it because the SEC, also known as the Securities and Exchange Commission, had a busy fiscal year, which ended September 30th. The penalties were up 67% from the previous year, hitting an all-time record of $6.4 billion collected.
And then it's kind of, we're joking about at the beginning here, but I do wonder where that money will go, or again, will it get lost in the tangled web of government administration there? The money is supposed to go to a fund that either protects investors, a fund that refunds investors who lost money, or the third option, the U.S. Treasury General Fund.
And that general fund just means it just goes to wherever they want it to go.
And maybe controversial, but I'm going to say it is, I hope the FTX deal, I hope that they don't use penalties to pay people that lost, because I think those are two different situations. I don't think the SEC should be involved with FTX because it's not a regulated security. So I'm just speculating here,
right.
But I would not want to see money from that go into that particular case because it's I don't think right. It's a different division of regulations.
Yeah, and I'm surprised you bring that up because I don't think they would, because Charles Schwab, broker-dealers and so forth, they do pay into, and I think we pay a small amount into the SEC as well. So we do have that.
And the SIPC
as well. So so they are collecting money for these reasons, but since cryptocurrencies had no regulation from the SEC, I would be like you, very disappointed, very even upset. Like, what are you doing paying these people back because it wasn't regulated by the SEC? Why would you dip into that fund? Now, again, some on the political side might say, well, it goes to that general fund. We should help these people out. And it's not like people didn't know that cryptos were risky. Yeah. We've talked about it. Jamie Dimon's talked. Everybody's talked about how risky
it was. In the news, yeah. It's everywhere. Warren Buffett called it, and Charlie Munger called it rat poison. It's... And, you wanted to speculate on it. You should have known that you could have lost everything.
Right. And you should not be reimbursed if you're speculating. Now, if you were in something where, and this is not going to happen. Let's say you're in Charles Schwab, and for some reason there's fraud there, and people lost money because that's different. Yeah. But this was just speculating. Not fraud. So I hope the SEC just says.
I've just kind of seen some people. We did a post on it on our Facebook.
People saying that?
People are saying, "Oh, the SEC should get it." I'm like, the SEC is not part of crypto,
right?
And that's kind of the controversy right now. And if the SEC does become part of crypto, maybe down the road, if it happened again, sure. But right now, that's not the rules of the game.
And I'm just thinking, if it was part of crypto, if the SEC regulated crypto wouldn't be around because they couldn't handle the regulations to do it properly. I mean, we've talked about this 6 months ago about how these audits have not been done on any of these companies. No. So it's just like it's all funny money. And now when you find something like this FTX, like, well, where's all the money? There never was any money.
It's so funny. You kind of look at the banks, and I saw that they're looking at that stress test and maybe even making it more stringent.
Right.
And it's like, I can't imagine what the heck would happen to all these crypto exchanges if they had to go through the same type of procedures that our big money center bank. They wouldn't be in business. There's no way they'd be able to handle those stress tests.
They couldn't handle that. So speaking of all this information, we do a newsletter. It goes out every Friday. Other things you'll see on the newsletter, we talked about Kavana. Gosh, that price went, I think, from 300 down to like 9. The GDP came out. We talked about the GDP surprises there. We did mention the JOLTS report. That's also on the newsletter. The National Home Price Index. We talked about General Motors, U.S. debt. All this information is on the newsletter, but you won't get it unless you sign up for the newsletter. So go to our website, smartinvesting2000.com. Again, that's smartinvesting2000.com. Sign up for the free newsletter. It goes out every Friday, just about 5 o'clock. So phone number's here, 833-288-0973. 0973. That's 833-288-0973. Let's go out to San Diego and speak with Wayne. Wayne, you're in the Smart Invest Show. Brent Chase, how can we help you out?
Good morning, gentlemen. I have a question. I'm looking at a pipeline transfer company limited partnership. How do you value them? The one I'm looking at is MPLX is the symbol.
Okay, and I'm having a hard time finding my there it is. Gosh,
I know. I think I talked too much this morning. So.
Yeah. Our
You're having
screens
a good time.
went blank. Yeah. Okay, and Wayne, do you hold that or looking to buy it there?
No, I'm looking at it. I'm trying to compare it to Kinder Morgan, KMI.
Okay. So let's take a look at the company again. And even the computers are slow here. MPLX, same thing as the symbol MPLX. They are in the oil and gas midstream here. Not much on the float, 3.3%. That's good. Surprisingly, only 23% institutional ownership. They've got a nice PE ratio, 9 versus 19.9. Price of sales, 3.2 versus 1.1. Price of book value, 2.5 versus 2.3, and price of cash flow checks in at 7 versus 7.3, and a very good PEG ratio, 2.6 versus 11.2. Now, the earnings are up 39% over the last year, compared to the industry down 20.9, so that's a big positive. However, sales are only up 18.5% when the industry is up 38.3%. They do have a 5-year growth rate of 3.7%, not as good as the industry growth rate projected at 9.6%. You get a nice dividend here, 9.2%. They only use 75% of the earnings to pay that out, but that's a pretty healthy dividend. I like seeing that. And then we do see current ratio is 0.8 versus 0.9. That's okay. Debt to equity a little bit high, 1.5 versus 1.4. I would want to check the cash flow on the company, see if that debt's increasing or decreasing. Because if it's increasing, I probably would say no to investing in the company. Nice net profit margin, 37 versus 6.3. And return on equity, very good, 28.1 versus 10.5. Jace?
Yeah, and kind of looking at the company here, the asset base for their pipeline assets actually dropped down from Marathon Petroleum. So I have seen this with other refiner companies in the past where they actually spin out this part and create this limited partnership. One thing that I've never understood, though, is if MPLX, do they only service Marathon Petroleum? So their business could be tied essentially to that refiner. Just something to keep an eye out on just to see if that could have a major impact on it, because if Marathon Petroleum slows down, well, then MPLX would slow down as well. So they could have somewhat of a strong correlation in that stock price. But looking at the current price here for MPLX, it's $33.82. The 52-week high is $35.49, and the low, $27.47. In the energy space, so not surprised to see this. It is up about 24.7% year-to-date. It hasn't done as well as the exploration and the refiners, but it is, again, still on a positive note when most of the market is negative. Now, going forward for MPLX, I go out to December 2023 and asked how we evaluate these limited partnerships. We're still going to look at the earnings. That's how we're going to justify our target sell price. Well, for 2023, again, December, it's $3.28, would give us a target sell price of $54.45. So the valuations look good on it. Brent kind of pointed out the debt level. And one thing that we always do have to point out again with the limited partnerships is the taxation is a little bit differently. So we got to kind of break that down.
Yeah, because the taxation, is this in a taxable account you're looking at, Wayne? Or
no, it would be in a retirement account, an IRA.
Yeah, so then you don't worry about the taxation on it. But
right.
for those
that's why I'm looking at it.
Yeah, those that don't buy it in a tax-deferred account, the taxation can be prohibitive.
Yeah.
So, but no, it looks pretty good. I'm just kind of worried about that debt, so that's the only thing I'd be watching there. All ready?
What caught my eye is it's got a 9 PE, and Kinder Morgan's got it's over 16 PE. So I was looking for what factor you used to do your valuation. You're still using a 16% number. So okay. Yeah. Happy holidays, gentlemen. Thank you again.
Okay, Wayne. Thank you. Have a good one.
When you have time, can you discuss why BlackRock is limiting the amount of money you can take out of the real estate REIT? Did you hear that last week?
I did not hear that last week, but
my assumption would be is the real estate's obviously illiquid many times. So if you take out too much of the cash, well, all they have left is real estate. So then they'd have to sell real estate, and they probably don't want to do that.
Yeah. They
were a huge investor in FTX also.
Yeah. Oh, well.
Could could be an issue.
Yeah.
Could be an issue. I would say so.
Thank you again, gentlemen. Happy holidays.
Okay, Wayne. You too. Thank you.
Bye.
Bye-bye. All right, that does open the phone line, 833-288-0973. That's 833-288-0973. And Chase, Wayne brought up BlackRock. And I've often wondered about that because I believe they're the hugest investment company now in the country. Because I think they had like trillions of dollars or something outrageous, I believe.
You know, I always confuse them and Blackstone. I think I'm thinking, is Larry Fink BlackRock?
Yeah, I think.
Yep. Yeah, Larry Fink's BlackRock.
BlackRock, yeah.
And they're the alternative.
Right. And they've just done so many things to become like, oh, this, and their stock price has gone up. And I just wonder if things will start coming through like this real estate, and I was not aware of it. But you're right. People are like, oh, I want my money back. They can't get it back because they've gone through all the cash, and they can't sell that real estate. If they have to sell that off, that would be a problem because then they'll have to sell at lower prices, and that could be some black eye, I'll say, for BlackRock.
When I don't
always like bigger.
Yeah, no, I don't always like bigger either. And I did see as well, like the state of Florida, they used them as an investment manager, but they're too worried about their ESG goals, and they're looking at paring back. And it's kind of funny to say, but the state of Florida's investment in BlackRock is still pretty minuscule compared to their overall portfolio. But again, that starts to kind of compound and grow. That could become a problem for BlackRock as well.
Yeah, and I think some of these, companies and so forth are kind of waking up that they don't want to be on the woke side.
Yeah.
Just do your job, manage the money, let us decide what we want to do politically. And same thing for people. If you want to be on that side, do it, but don't have a BlackRock or somebody else force you into this. And I think Disney's kind of paid a little price on that as well.
And it is funny. I saw there's a congressman that was talking about BlackRock, and he's like, look, we pay you to manage the money, basically. If you want to get into politics, by all means, get into politics.
Right.
But that's not what we're paying you for, to be in politics.
Yeah, exactly.
It is interesting.
Yep. All right. Phone number is 833-288-0973. Again, that's 833-288-0973. Let's go up to Inglewood and speak with Dorian. Dorian, you're in the Smart Investor with Brent Chase. How can we help you out?
Good morning, Brent and Chase. Yeah, I wanted to ask you about U-Haul, the truck rental company. I drive by the lot every day, and I notice it's always empty on weekends, and they kind of have the trucks all come back during the week. And I bought some of this about 5 years ago because I wanted to own some of those orange trucks. I doubled my money, and I said, well, maybe I want to get some more. I looked at the PE, it's 12. The company's been around for 70 years. They don't pay a dividend. And, it looks pretty safe because who else competes with them? People, when they want to rent something, they rent a U-Haul truck. I was wondering, what do you think about buying some more?
Yeah.
UHAL.
And I think you're right because they do have kind of a hold on the market. When I try to think who else you would rent a truck from for hauling, I can't think of anybody else. U-Hauls.
Well, there's Penske, but they don't rent little trucks, and there's other ones.
And there's like Ryder, I think, as well. Ryder. But I think they are more Ryder's more towards like I think the bigger companies and like bigger trucks. I don't think you would use a U-Haul.
U-Haul's done a great job of making it for the individual consumer. Yeah. So let's look at the numbers here because you could be honest on Dorian. Company again is U-Haul. Symbol is UHAL, just as it sounds there. Only 0.5% on the short side, so no one thinks it's going down, but it's small on the institutional side. Only 37%. We do see the PE ratio looking pretty good at 12.4 versus 18.4. Price of sales 2.2 versus 1.5, which is surprisingly high compared to the industry. So disappointed there. But price to book value looks good, 2.1 versus 37.4. Price of cash flow checks in also on the high side, 8.1 versus 4.9. And PEG ratio only 0.9 versus 4. So that's a good PEG ratio there. Now, the earnings over the last year are up 4.2% versus the industry at 63.3, and they're the industry of rental and leasing services, so kind of a more general industry, so maybe that's not why they're not doing quite as good. We do see sales are up 10% over the past year, industry up 16.4. They do have a 5-year earnings growth rate of 15%, which beats the industry at 12.7. They don't pay a dividend. I'm surprised on that. I would assume a company like this would pay a dividend, but they do not. We do see on the balance sheet, current ratio 1.5 versus 1.7. Debt to equity is 1, far better than the industry at 3. And then net profit margin 17.9 versus 10. Return on equity 16.7 versus 6.1. And return invested capital also 9.8 versus 8.1. So I kind of like what I'm seeing here so far. Chase, what do you got going forward?
Yeah, so current price here for U-Haul, company goes by Amerco as well, I believe is actually the official name of the company, it appears. But the current price, $66.84, 52-week high, $73.16, and a low, $44.79. I see year-to-date down about 7.8%. And one thing I was thinking about while talking through this is there was kind of a big boom of people kind of moving around after COVID. That's something I would want to kind of analyze a little closer. Is that going to continue? And we kind of talked about as well with the real estate slowing down. If real estate slows down, that could impact U-Haul because people might not be moving around as much.
True.
So something to consider there in terms of what's going to happen with this business going forward. I do see the market cap for this company, though, is about $13 billion. And I'm a little surprised by that because it's obviously a good-sized company. Mm-hmm. But when I look at the analysts for the earnings per share, there's only one analyst. And it only goes out to March 2023.
Wow.
So that's all I can see here. But that's already, most of the time we would like to look at March 2024 to go out about a year and a half. But for March 2023, I do see estimated earnings per share is $5.61. It would give us a target sell price of $93.13, so that still looks attractive. But this is kind of what I was talking about, is year over year, it looks like the earnings are expected to decline by about 2%, and we don't have any numbers for 2024. And again, it's just one analyst. So how positive is he going to be, or negative is he going to be, or she going to be? So that's something to really consider. I like, again, at least probably 5 analysts.
And Dorian, I got to ask you, how much percentage-wise does this make up in your portfolio?
Not much.
Not much, yeah. I was excited about the company, and then I saw one analyst. There's something going on there. Why only one analyst for a $13 billion company? Maybe it's just too boring. And also, too, Chase brought up the good point, too, is that, with real estate not doing what it did in the past, perhaps the U-Haul rental will come down. So I've got kind of, even though the numbers look good on it, some of the numbers, I'm going to say no. I don't think I'd want to buy this right now. I think I would.
Yeah,
would look
it
somewhere
is.
else.
It's not going to crash, right?
No, I don't see it crashing.
It may not go up.
Right.
Yeah. One experience I had yesterday, I bought 2 new tires for $499. I bought the same 2 tires at the same place 18 months ago, and they were $386. So that's a 29% increase. So we have an inflation problem.
Well, and again, I think that tires are made from petroleum, which is rubber, so that could be turning back down. So if you have tires in your car, and I'm known for having my tires go to almost bald, so I wait and put tires in my car. So if you are looking at having tires, you did already, but somebody else, I'd say, wait a little bit, because I think you will see those come down. So, all right, Dorian?
But I'm worried about the inflation is bad. It's bad out here. We know that.
Certain areas it's bad, certain areas it's not bad, and again, I mean, it's just, and 40% of the inflation rate does come
the CPI.
The CPI comes from housing. So there are things you can find that, like tires, are up dramatically. There's other things you'll find like, oh, that wasn't so bad. So, but yeah. All right, Dorian, thanks for calling. We'll talk with you soon.
Okay, thank you.
Okay,
bye.
Bye. All right, that is open the phone line, 833-288-0973. That's 288-0973. Oh, and I just realized it's time to talk about financial planning with our financial planner, Harrison Johnson. Good morning, Harrison. How are you doing this morning?
Hey, guys. I'm doing well. How are you doing?
Well, good. I saw the topic today, and, I'm going to a lot of charity events and so forth. This is the time for charity, and you're talking about change for charitable donations this year. What's the change about?
So in the last 2 years, there was a provision in the tax code where even if you were claiming the standard deduction, you could still get some tax benefit from making some charitable distributions. It was $300 per person or $600 for a married couple, that if you made a donation up to that amount, a cash donation, that you would get that tax deduction in addition to the standard deduction. So you didn't have to itemize to get it. But 2021 was the last year that is going to be available. When they were first initiating that, there was some talk that it was going to, last indefinitely. But this year, for tax year 2022, that's no longer going to be available. So what that means is, if you're thinking about donating to charity, you might have to do it a little bit differently. So if you want to get a tax benefit for any charitable deductions, you either, number one, have to itemize, but you either do or you don't. If you don't have enough itemized deductions to get above the standard deduction, you're not going to do it. And basically, in order to itemize, you need a pretty large mortgage, and you need that mortgage interest deduction in order to get over the hump of the standard deduction. So that's just not realistic for a lot of people. So another thing that you can look at doing is gifting stock. And when you gift stock, you can deduct the fair market value of whatever the stock is, and that's an itemized deduction, which, again, if you're claiming the standard, doesn't help you. But if you have appreciated stock and you gift that, then you don't have to pay taxes on that realized gain. So that is some tax benefit, even if you are just claiming the standard deduction. Another thing you can do is look at making qualified charitable distributions. So if you are 70 and a half or older, you can send to charity donations directly from your IRA account. And in that case, the distribution from the IRA is not included in your income, so it's essentially not taxable. And that really comes in handy when you're older than age 72 and you have to take your required distributions from your IRAs. So if you're looking at a way to mitigate that, you can use some of that to give to charity through the qualified charitable distributions, and essentially gives you a deduction. And then lastly, even if you claim the standard deduction on the federal side, you can still itemize on the state side and get a tax benefit if you're making charitable donations there. And in California, the standard deduction is much lower than it is on the federal side, so it's much easier to itemize. It's about $5,000 a person or $10,000 for a married couple or so. So even if you are claiming the standard federally, you can still itemize on the state side and get deductions there. So again, there's a little bit changes that we have this year, so you might want to be careful how you're giving to charity this year.
Yeah, I mean, it's always such a great benefit, obviously, to give to charity, but sometimes it is nice because
Right.
you can give more to charity if you get a tax deduction, perhaps. So it is a good way to kind of consider these different options because it helps you and it helps the charity if you're able to give a little bit more money as well.
Yep. So it always does feel nice to kind of give to charity, but again, it is kind of nice to have that tax deduction.
Well, essentially, the big thing is, again, if you can write off some of it,
Right.
rather than giving, let's say, $2,000, you might give $2,500 because your net cash flow is still the same.
Yeah, that's a good way of looking at it. Well, Harrison, thank you very much. We will see you on Monday morning.
All right, thanks, guys. We'll see you Monday.
Okay. Bye-bye. All right. Yeah.
I was going to say, not on the charity topic, but on the BlackRock topic, I did find at the beginning of this year, they had $10 trillion in assets under management.
10 trillion. Yeah, I knew it. Because a trillion was not as big enough, but 10, and I think they're the largest at 10 trillion.
It could be, yeah. I mean, that's a lot of money.
Yep. Phone number is 833-288-0973. That's 833-288-0973. Let's go up to Encinitas and speak with Paul. Paul, you're in the Smart Invest Show, Brent Chase. How can we help you?
Oh, hi, guys. Yeah, I'm normally a tech investor, but, tech's really going nowhere these days. Got money on the sidelines. I'm looking at MMP. It looks like it has a healthy dividend, a low PE. What can you tell me about this Magellan Midstream Partners?
Okay. Well, let's take a look at that. And do you hold that? It sounds like you're looking at buying something else is what you're kind of saying here. Is that correct?
Yeah, just looking. I want to put some of my money to work. Just sitting on the sidelines, and with inflation, it's actually losing money.
Right. And one thing I will say, I mean, on portfolios is that you never want to be too excited to invest the cash quickly. I mean, sometimes you want to look for opportunities. I mean, right now for new money coming in, we're sitting on a fair amount of cash because we're being patient. So don't get too impatient. But also, it's always good to look. But don't say I gotta put it to work. And you use that thing that people say like, oh, but I'm falling behind with inflation. Well, if you buy something and it goes down 10%, you're even further behind. So always be patient. That's our thing is be patient. But let's take a look here for you. The Magellan Midstream, MMP is a symbol. They're in the oil and gas midstream. Only 4.2% short on the stock here. Institutional ownership, 52%. Pretty good start. The PE ratio, 12.3 versus 19.9. Price of sales, 3.5. That's expensive compared to the industry at 1.1. Price to book value, 6.5 versus 55.7. And price to cash flow, 10 versus 7.3. And the pay ratio, very good, 1.9 versus 11.2. Now, their earnings per share over the last year were up 5.2% compared to the industry down 21%, and sales for MMP were up 21.7, not quite as good as the industry growth at 38.3. We do see a 5-year estimated growth rate of 5.5%, not quite as good as the industry growth projected at 9.6. You do get an 8% dividend. They use 80.3% of their earnings to pay that out. Look at the balance sheet. Current ratio 1 versus 0.9. That's good. Not thrilled on the debt to equity, 2.9, more than double the industry at 1.4. So I'm not sure why they have so much debt in the balance sheet. I would be kind of worried about that. We do see a net profit margin 34.7 versus 6.3. Return on equity 60.5 versus 10.5. It kind of tells you maybe they have very low equity. Maybe that's why they have such a high debt to equity. And then return on capital looks good, 19 versus 26.9. Chase, what do you got?
Yeah, so current price here for Magellan Midstream, again, MMP, $52.48. I see 52-week high here, $54.40, and the low, $43.58. And like the first company we looked at, I think it was MPLX, this is, again, another master limited partnership. So, again, you got to really be careful. Are you looking at a taxable account here or a retirement account here, Paul?
Yeah, probably retirement account to avoid, more taxes,
Okay. Yep. Just want to make sure on that because that could always, throw off the investment returns if it messes up the taxation there. But looking at the valuations going forward for MMP, I see in December 2023, the estimated earnings per share, it's $4.84, would give us a target sell price of $80.34, trades at a forward PE of about 10.8. So, the valuations on it look pretty good. It's just, again, that debt level was a little concerning.
And I do say actually those earnings, you don't see this much now, but the earnings from 90 days ago were up from 469. So actually increasing as opposed to most companies look at, 90 days ago they were higher. And also, too, Paul, I got to ask you, percentage-wise, how much do you have in energy in your portfolio?
Yeah, it's going to be less than 10%, I think, right now.
Okay. Well, if it's 9.9, I'd say you're pretty well set on the energy side. So I don't know if I'd add more or not.
Okay.
All right. So, all right. Well, Paul, thank you for calling. And you have a good one.
You too. Have a good day.
Okay. Bye-bye. All right. That does open the phone line, 833-288-0973. That's 833-288-0973.
And, it's interesting anytime somebody calls in about the pipelines. One thing I always talk about is we never look at the pipeline just because I don't like that they're limited partnerships. Right. It's just too complicated with the taxes and so forth. So I'd rather avoid the complication there. But one thing that I've always encouraged people to do if you're looking at buying the pipeline is understand how they make money. Yeah. Like, do they, because obviously with the price of oil, the price of gas, the refiners are making their sales based off the price of the refined products, and the exploration companies are making money off the price of oil. But they're not selling the commodity, they're transporting the commodity. So how do they charge to store or to transport? Is it, just a flat fee? Is it based off of how much they're transporting? Because it could be more beneficial if your prices are lower, perhaps, and you're transporting a lot more. Right. Maybe they make more money. It's just something that I've never looked at or understood, but I encourage people to understand how they make money and what's going to be a beneficial time for them for their business.
Yeah, and that's one thing that, and again, they talk about the master limited partnerships because that's primarily what they do is the pipelines, is really understand. It's like, you get that 9% dividend. It's pretty exciting, but how are they making the money? What could cause that to go the wrong direction? What if they close the pipeline? What if they open more pipelines? How does that affect that investment? That's what we always talk about is really understanding the investment, because we can run over the numbers here for you, try to point in the right direction, but there's so much more into it. And that's why in our portfolio, I would say, I think 2020 was probably our busiest year. I think we maybe did I'm going to say maybe 10 buys that year.
Yeah, that's a lot.
Normally, like this year, this year's almost over. Did we do 4 or 5 this year maybe?
I don't even think it was that many. Yeah. I think we had, it might have been honestly only 2, 3.
2 or 3, yeah. And we look at a lot. We look at them here. If we find something here, we like it. But it's not about the quantity of the trades. It's about the quality of the trades. And I'm not going to say use the word trade. I would say the investment, the quantity of the investment that you do, because that's what investing is really about. And we're just about through this year. I can't believe we're here in December. It's not been an easy year. We've seen some people that, oh my gosh, their portfolios are down. Can't tell you what we have done this year because of the SEC rules, but I've slept very well at night. I'll put it that way. So
Yeah, definitely. I mean, there's nothing I'm worried about in the portfolio. And one thing I was going to say, too, is I don't like to complicate things when we invest. And, there was a situation we had at our firm where there was a position that was sold in a Roth for one of our clients. And it wasn't something that we bought. But somehow, and again, we're not accountants, so I don't know the taxation of everything, and especially in products that we don't buy typically. But somehow within the Roth, that position was taxable to the client.
yeah.
And I had never seen this before. And again, because we don't complicate things, we keep things pretty simple. But that's one thing I'll tell people is, again, with these master limited partnerships, I think it's fine in a retirement account. But I would just want to confirm, because that could be really detrimental. You get a product, you're like, oh, great, I sold it. And all of a sudden you get but it's my Roth.
Right.
So be very careful. And I think it's okay with the MLPs, but I'm not a tax person. I'm not 100% sure on that. Make sure before you buy any investment that's not your typical stock, typical company there, that you're not going to get burned on the tax side of the equation down the road.
Right. And I was going to talk about Carvana, because I mentioned that early in the show. We do have a caller coming in, Val, so I'm going to go to him in a minute. But I had pulled up Carvana, just kind of look at it, and I was wrong. They've not been over $300 a share. Their high is $274. They closed on Friday at $807, so they're down 96.5% year to date. And this was something interesting as well. The short is 66%. So yeah, I mean this company's not going to come out of that. So somebody owns it, and I'm going to say, hopefully, don't call in and want to buy it.
Yeah, and it could be one of those Reddit trades, but I think the days of the meme stocks have definitely slowed down, because that's generally what they target, is trying to get the short squeeze. But
right.
I mean, I wouldn't want to get stuck with a company that's got those debt levels, and you're going to have to liquidate all those cars to try, and their cash flow is terrible. So it'd be not a situation that you'd want to be stuck in a short squeeze type situation. All of a sudden the company goes bankrupt.
And you talk about those meme stocks. I guess that didn't work out too good, did it?
Did for some people.
Few
But
people.
for the most, it did not.
For most. That's the thing. Some people always get something. Somebody wins the lottery, but most people don't. I never have.
Yeah.
So, all right. Let's go out to San Diego and speak with Val. Val, you're in the Smart Investor with Brent Chase. How can we help you?
Yes, I am trying to figure out why SFL, which pays nearly a 10% dividend, is such a price laggard in its transportation group. They're an international shipping company, and I'd like to see a comparison of SFL with, say, HDT Holdings.
Well, and what we can do, and one thing comes to my mind, we talked earlier in the show about diesel. When I see marine shipping, I'm thinking they use a lot of diesel for their ships, so that's probably one reason why they're being held down. But I do want to go over the numbers, because just a quick glance of the numbers do not look that bad. So I see why you're kind of baffled why this is not moving. So let's take a look at a little bit closer. SFL, that's the SFL Corporation. Not much on the float side, on the short side, 2.4%, only 35% institutional owned. We do see a good PE ratio of 5.8, but the industry's at 1.8, which is a very strange number. Price to sales, 2.3. That's above the industry at 0.7. Price to book value, 1.3. The industry's at 0.3. So some strange things going on with this industry here. Price to cash flow for the company, 4.3. The industry at 1.5. So I'm going to continue on here, but one thing I'm thinking is that perhaps SFL is higher valued. There's better deals in the industry, so that could be part of the problem. Let me continue on here. I see no earnings per share growth over the last year. The industry was up 74.6%. The sales for SFL were up 31.2%, slightly better than the industry at 29.2%. We do see that 9.2% dividend. They use 44% of their earnings to pay that out, but the industry pays an average of 18.5% with a payout ratio of 24%. So again, great numbers for the company, but the industry just appears to be far better. Looking at, this is dangerous. Current ratio 0.3 versus 1.9. This can be a problem because if the company doesn't have liquidity, they could have to file for bankruptcy very quickly, and they have a debt to equity of 2.3 versus 0.6. I very rarely see a current ratio so low of 0.3. That's a liquidity problem this company's having. Net profit margin 37.5 versus 37.6. Return on equity 21.9 versus 54. So I'm really concerned that liquidity. Chase, do you see on the numbers going forward?
This is real quick too, especially on the dividend. That could easily be a reason to cut the dividend. If all of a sudden things slow down, they can't afford that dividend anymore. That could be one reason the stock's being weighed down. Is people are like, I don't believe that dividend's stable. One other thing, too, that I know with another shipping company, I forget the name of it, but they changed their dividend formula to a percentage of profits, essentially. So it wasn't a constant dividend. I would want to make sure how this company actually pays out that dividend. This looks to be in the oil and gas, transportation for marine shipping. I believe the other company was just a large marine shipping company. But that is something, and either way, honestly, I'm kind of worried about the dividend anyways, because that current ratio is so bad. But looking at the current price here for SFL, it's $9.99, 50-week highs $11.60, and the lows $7.64. Even though I said it has kind of lagged some of its peers, I see year-to-date it's up about 30.6%, so it's still been positive. And this is strange, too. I'd have to look closer at the industry because I do see the industry as a whole is actually down 19.2% based off of the industry that we look at here. Looking at the market cap, though, it is a pretty small company at $1.3 billion. They still have 4 analysts that follow it, however. And I go out to December 2023. I see the estimate for earnings per share is $1.30. That would give us a target sell price of $21.58. So, I mean, again, the valuations look very, very good on it. But, gosh, that balance sheet could be one reason that people could be concerned about it, and that could be impacting its stock price.
Hey, and I was over and Val's gone, so either he was on a cell phone and we lost him, or we didn't like what we were saying. But I did also look at the balance sheet. Their cash and short-term investments now $204 million, was $300 million back in September 20th. So it looks like their cash is drying up. And you're right. What could happen is they could say, "Gosh, we got to cut that dividend. We don't have liquidity to pay our debt payments." They got $963 million in short-term debt, long-term debt $1.5 billion. This company could have problems down the road. I think Val said he had owned it. I would have to sell and get out of this one. I'd be very scared.
Yeah, and I mean, I kind of see what he's I pulled up a couple peers of theirs, and it's like TNK, that year to date's up like 221%. DHT's up 100%, while this was up 30.6%. I see one of their other peers is GEL, that's up 1.94%. So there's definitely appears to be a discrepancy, obviously, in the industry, but you can find that anywhere, anyways. If you look at, I'm just going to pull out the chip companies.
Yep.
I mean, you look at like NVIDIA, Intel, they don't all move the same. There's going to be different factors that impact each business. So, I mean, unfortunately, we don't have enough time to do a deep dive into each one of these companies and try and figure out why this one has lagged, let's say, a TNK and a DHT.
Yeah, and that's why, again, it comes back to, and Val was liking the dividend. Why is this not going up was his question. And I think we found some good reasons why it's not going up. Liquidity is a big problem, and I almost want to say I've never seen current ratio 0.3. I'm sure I have, but I can't remember the last time I saw a current ratio so low. It's just, I mean, that worries me a lot. I mean, and it's not the company that files a bankruptcy; it's your creditors. The creditors will force you into bankruptcy, and they've got a lot of creditors. I said, what, $900 million in short term, $1.5 billion, I think it was, in long term debt. You got probably not one creditor, probably multiple. If they say, you know what, we're feeling uncomfortable, you're paying out that crazy high dividend, we're going to force you into bankruptcy.
Yeah. The only thing that I could say that could be hope is I have seen in the past where cash outside the U.S. is held in long-term investments, so it's not readily available. If that's the case, you could maybe pay off debt outside of the United States with that cash. But that, again, comes down to understanding the balance sheet. That's a big problem to have a current ratio of 0.3. You got to be able to explain why the current ratio is there, and is it going to be okay to make it out of that? Because that could be, again, very detrimental, especially with such a high dividend yield. That's all of a sudden that business slows down. They don't have the cash flow anymore to pay that dividend. They still have to pay their debt. They can't pay their debt. That's when they go bankrupt.
You know, it's funny, and I think a lot of investors miss looking at the balance sheet. And that's why we're so confident we do stuff. Look at the balance sheet. And unfortunately, there's a closing bell, so I can't expand on that. Thank you for listening to the Smart Investing Show. It is for informational purpose only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-546-4306. That's 858-546-4306. And visit our website, smartinvesting2000.com. That's smartinvesting2000.com. And for more daily educational information along investment tips, go to our Facebook page, Smart Investing with Brent Chase Wilsey. Thanks for listening to the Smart Investing Show. We'll be back next week right here to talk about investments on the Smart Investing Show.
To think that I did all that, and may I say